Welcome to you all to today's online debate organized by the Florence School of Banking and Finance on the topic, the French-German COVID-19 recovery plan. My name is Elena Carletti. I am a professor of finance at Bocconi University, and I have the pleasure to moderate the debate today. So let me introduce and welcome our speakers today, Mr. Jörg, the State Secretary of the German Ministry of Finance, and Mrs. Odile Renaud-Basso, the Director General of the French Treasury. Thank you very much for being with us today. We know that you have a very tight demand on your time, so we are particularly grateful. Last but certainly not least, let me also introduce the fourth person you see on the screen, Pierre Schlosser. He is the scientific coordinator of the school, and he will step up in case anything happens to my internet connection. So now Pierre will disappear, and in case we have internet connection problem, he will take my role. Thank you, Pierre, for doing it. So today's seminar will discuss mostly the French and German proposal, as we said, and also the relation with the proposal put forward by the European Commission. So we will start with each speaker giving introductory remarks for about 10 minutes, and then we will open up the floor for discussion. Given that today we have an hour, normally we have 75 minutes, and given that we have really many connected today and the importance of the debate, we thought of collecting some questions from the participants already before the webinar. So we will add this question to the question we prepared, and then eventually in the last part of the seminar, if we have time, we will allow for general Q&A from the participants. So without further ado, given that we are really looking forward to what you're going to tell us, I would like to give the microphone to Mrs. Renaud-Basso for her remarks. Please.
So this joint Franco-German proposal has been seen as a game changer, a major step forward, and I will just present first of all why did I think our two countries made this proposal and what are the key features. So first, why this proposal came at that point of time, a little bit more than 1 month ago. First of all, I think that we will all agree that we are facing a major crisis. One, that we have not seen since World War II. This is a crisis that touched all European economy, a major shock for all European economies, also worldwide, because we see now, the epidemic touching all developed and developing countries. In France, the assessment we have on the impact of the crisis is a growth of minus 11% in 2020. There is a lot of uncertainty. It may be a little bit better, it may be worse if there is a return of the epidemic. But the shock is huge. No need to further detail on that. The second point is that member states, and it's very important to underline that, member states have taken at national level huge measures of support. They have addressed the crisis very quickly and very forcefully. I remember the discussion mid-March or end of March in the Eurogroup, and we were discussing support of about 1% of GDP in terms of fiscal support, few percent of GDP in terms of guarantee support. Now we are much beyond, and all countries have done huge efforts. I will give a short focus on France, and I think countries took some very similar measures. What are the key measures we've taken? First of all, bank guarantees. The government is guaranteeing bank loans for companies of all sizes, and basically we have set up an envelope of 300 billion euros, and up to now more than 100 billion has been used and drawn. So it's liquidity pouring in companies from all sizes. Second, very big measures, and on that we relied very much on the experience of Germany in the global financial crisis, which is a partial activity scheme. We basically took the same parameters, and this represents support for households of around 30 billion. Then we have postponed a lot of tax payments for around something like 30 billion, provided subsidies to very small companies which have been very deeply affected by the stop of the activity, 8 billion. support in equity for companies, and also support to the most fragile households, poor families, children, and so forth. Overall, this represents a package of more than $500 billion. You have some budgetary expenditure, guarantees of balance sheet measures, and so forth, but this is a huge effort, and I think all European countries are doing the same kind of effort with the same sort of instrument, some nuances and so forth, but basically the same structure. Complementing that, there has been also some emergency measures at the EU level, decided on state aid, fiscal framework with the global escape clause, measures agreed by the Eurogroup early April on the ESM, EIB, SURE, and so forth. But so there were already a lot of things done, but I think our two countries agreed that something more was needed, and we needed to go beyond this national and European intervention. And in my view, there are three key reasons for that. The first one is the risk of economic divergences. We are having a symmetric shock with asymmetric effect, and countries are affected very differently because of health reasons, but also because of the structure of the economy and margins of maneuver on the fiscal side. The second reason is that I think we understand that there is a risk of losing ground if Europe does not provide a huge amount to kickstart the economy, support investment. There is a risk of that what happened in 2000 post the global financial crisis, which is a decrease in investment, that could have dramatic effect on the role of Europe in technology, sovereignty, leadership in these areas. And the third element, which is of more political nature, is the need, I think, to show that there is some, European solidarity and European capacity to support countries facing difficulties. So that's why we did that. Then a few words on the key features, and I will be very quick because I think it's well known. The first one, the key elements of the Franco-German proposal is a big fiscal capacity, fiscal instrument, fiscal fund of 500 billion euros financed by debt issued by the Commission on behalf of the community to finance budgetary expenditure with a strong focus on green transition and digital transition. And the key features, which is to issue debt for benefiting from very low interest rates to finance this short-term expenditure, very important to support the economy. I think this was the right decision to make at that time in view of the challenges we are facing and the financial market condition. And this is really a big step forward. I think this should be related, together with the MFF, on which there have been also some proposal, but really I think this recovery fund is the key pillar of the proposal, and I think it's very positive that both countries managed to reach a compromise on this ground, because it really changed the dynamic of the discussion in the EU level, and it provided the basis for the Commission to come with a very ambitious proposal that is now being discussed and will be discussed in the coming weeks. I will stop here if you wish, if you may.
Thank you very much. Mr. Kukies, please.
Thank you. And I actually can just copy a large amount of the statements that Odile made. I had the honor of attending the Franco-German Parliamentary Assembly yesterday, where the French Finance and Economics Minister Bruno Le Maire illustrated quite clearly how in sync Germany and France are on fiscal policies. And if I were to explain our approach and our fiscal response, I would say pretty much exactly what Odile has just said in terms of guarantees, short labor schemes, now accelerating out of the crisis with consumption incentives, programs to promote green economy with our hydrogen program of 9 billion, with our digitization, quantum computing program. So it's quite fascinating how similar the fiscal response of France and Germany is as a response to this crisis. So I won't bore you by basically reiterating everything that Odile has said on these issues. Interestingly, the take-up of the liquidity measures in Germany is about half that of France. We're at just under 50 billion at the moment. In the KfW state-guaranteed liquidity programs. So in that sense, I also think that puts a little bit into perspective the statements that we constantly get that Germany is doing far more than the rest of Europe, and that a large part of the state financed recovery plans are coming from Germany. I think we're perfectly in line. And all of the programs that we've launched are completely approved and discussed with the EU Commission and completely compatible with the EU rules and regulations. And as I said, the take-up in Germany isn't even half the size as in France. So in that sense, I think we're not concerned about that. By the way, I think. It's always a question of when we don't want to influence the decision by the corporate sector on when and if and when they take up the government programs. And in a way, we think if the fact that the take-up is significantly lower than anticipated is also a sign that the financing markets, both for banks and in the corporate bond markets, have recovered much faster than anything that we were thinking of in March. I mean, we've seen quite substantial volumes raised in the debt markets over the past few weeks. So we take that as a sign of encouragement. On the European topics, it's been a very fruitful collaboration between France and Germany. Basically, since Olaf Scholz took over in the finance ministry, we started a sequence of initiatives together with France, and from the Meseberg Agreement to the banking package to the ESM reform to the Eurozone budget, a lot of these European initiatives have been driven by Franco-German proposals. And if you see the proposal on the recovery fund and compare it to the recovery instrument, you see quite a lot of the elements that President Macron and Chancellor Merkel suggested actually found their way into the Commission proposal. So we're quite happy that the collaboration is producing such positive results. And certainly the fact that a lot of the initiatives of European legislation that we will start in our presidency will most likely be concluded by Odile and her team when France has the presidency. Also indicates that there will be quite a lot of collaboration on all of these bigger topics of closer fiscal integration, banking union deepening, capital markets union deepening, digital union launching, that we are focusing on in our presidency will certainly, if the sort of 2-year legislative cycle in Europe, which is sort of a standard, holds true, then quite a lot of the things that we are starting with now will probably go roughly into the first half of 2022. Sustainable finance is the other very big topic that we're working on together. France was much faster than Germany in issuing green bonds and launching that segment of financial markets, which is extremely future-oriented. A few years after France started, I'm happy to report that Germany will soon issue its first green bond as well. So I think that's also very important in this topic of greening our financial system and our economy. So with that, I'm happy to take questions and to answer whatever I can together with Odile.
Thank you very much. You have both touched on a number of topics that we will go back to in the discussion. First of all, the national measures that you have implemented in each of the two countries and possible divergences with other countries. and the very strong French-German cooperation. But before we go there, let me go back to something that Mr. Renaud-Basso said at the beginning, which is that indeed your French and German proposal is somehow a sort of game changer. It has been seen and welcomed, in particular by markets, I would say, but not only by markets, as a really game changer. And some people, including Mr. Scholz, even define it in a Hamiltonian moment. So to which extent do you see it to be a Hamiltonian moment? And related to that a little bit, if it is a Hamiltonian moment, then somehow this is linked to more fiscal policy or more future, if you want, a measure for Europe. So on the one hand, the proposal is seen as a temporary, or it has been suggested as temporary, but on the other hand, in particular because it suggests, as Mrs. Renaud-Basso said, that the Commission raise bonds and also that can finance it through European taxation, somehow hint to a sort of more, if you want, a longer term type of arrangement in the European framework. So in other words, do you see it as being the first step to more fiscal union and eventually political union? So I'm asking these two questions on the Hamiltonian model and the possibility that this become a first footprint for fiscal policy and for fiscal union and political union. I'm asking maybe one to each of you, but please feel free to respond as you see fit, as you prefer. Maybe first going back.
Thank you. I mean, this is a very good question, because I think that on the one hand, as I was saying, it's a major game changer. And we are doing something, and the Commission will do something that has never been done in the past, and provided a huge fiscal response to a shock based on debt issued at the community level. So that's very new. Up to now, the Commission could borrow, but only to lend to countries, so it was only back-to-back loan. Now they borrow to spend. And that's a big change. On the other side, it's very clearly stated, and I think we will get no agreement if it's not clearly stated and clearly reaffirmed, that this is a temporary fund for targeted need, and it's a crisis tool. So it's not, the intention is not to say in 2 years, well, let's continue, increase the fund and create a new permanent budget, increased budget of this magnitude at the European level. So I think that, but this being said, this doesn't mean that this is not revolutionary. And I think the big signal it gives is first the capacity of Europe to react very quickly at the community level. And this is very different from what we did in the previous crisis, where we had a lot of discussion among governments to create new instruments and so forth. So now we found it in the community method, and we react very quickly. And this, of course, I mean, once you have done it once, maybe if you have a further major reason to do something like that, that exists. But I think it's also very clear, if we want to move forward now, to be very clear that this is temporarily targeted. So I'm not sure that is, I mean, it has some elements of an Hamiltonian moment. It's not exactly what happened in the US with Mr.
Kukies?
Yeah, so as Odile said, the only chance to get a political compromise on the recovery instrument is, of course, the fact that we very explicitly say that it is a one-off instrument. That is both the case within the German government and across Europe, where many member states who are quite critical in principle of this proposal say the only chance they have to get this through their respective national parliaments is if we declare this as a once only and never again and only response to the severity of this crisis, and it'll never ever happen again. I think that's to be decided afterwards. I think the key goal now is not to philosophize too much about whether this is a Hamilton moment or not. It's get the deal done, right? I mean, that's the immediate, urgent response that we need to give. And then I promise during our presidency, we will have a lot of discussions once we have the fund approved on whether we can move towards a closer fiscal integration. because of course the question of whether we can succeed at bringing debt capacity, expenditure capacity, and tax capacity to the European level, and therefore achieve a Hamilton moment. That, of course, is something that we need to discuss post-recovery fund. For the recovery fund itself, I think it's not necessarily required to have that debate, but afterwards, I definitely think it needs to be discussed, because we will have the review of the Stability and Growth Pact. We will have the debate around how to finance the recovery fund. For example, we have proposed that we can imagine using the emissions trading system at European level to generate fiscal capacity for the European Union. We could imagine, in the context of capital markets union, moving quite a lot of the capital taxation instruments to the European level, which would also serve the sort of positive side effect of having a positive impact on capital markets union, in addition to providing own resources. So I think that discussion will be extremely interesting. One of the elements that we were surprised hasn't found a huge amount of reception or response in Europe is that Olaf Scholz in his interview also proposed moving entire policy areas to the European level. And he specifically proposed moving development cooperation to the European level, and basically doing what we're doing in customs, for example, and just moving the entire policy to the EU level, both in terms of the revenues and the resources and the competencies. I think we'd be willing to have that debate. To me, development cooperation is one of many examples of European common goods, which would make a huge amount of sense to move to the European level, so that we face the challenge of the Belt and Road Initiative and many other regions' initiatives in development cooperation at the European level, instead of having 27 dispersed initiatives on, for example, how we deal with the crises in Africa. So we're very open to having these debates and turning the recovery fund discussion into a true Hamiltonian discussion in the second half of the year.
Thank you very much. So let me still on the importance of this proposal, and then we move on. So Mrs. Renaud-Basso, you said before that this is indeed a very important crisis in many dimensions. First of all, because it's completely exogenous and it hits a country asymmetrically. So this is really the moment for some European solidarity in a way, or at least it justifies European solidarity much more than previous crises. Think of the 2011 and 13. It's a completely different starting point. So Professor Enrico Perotti from the University of Amsterdam on this issue would also like to ask if this fiscal solidarity is legitimate not just because of the current situation and the current crisis, but also possibly because since the euro has been introduced, we have seen a devaluation for the core countries that has somehow increased their competitiveness. So do you think that the solidarity that comes now also somehow is related to what we have seen since the introduction of the euro, or is somehow completely disconnected from it?
No, I think it's not completely disconnected, because what we are trying to do with the instrument is to address and to provide some financing for those countries that need it, and those countries that need it will be the one the most affected by the crisis, but also the economies that do not have so much internal capacity to rebound, and that needs to have external support to support the recovery. So I think, we are not just dealing with the health dimension and so forth, but more, the global economic impact of the crisis on the different countries, and that, of course, and their capacity to respond and to address it. And that's, of course, it's the outcome of what happened in the euro area and what the challenges they were facing in the last few years. So it's a mixture of them. Of course, the very short-term focus is on the impact of the crisis, but what happened is reflected in the situation of the countries today. So I think that's quite clear.
Okay. Thank you. Mr. Kukies, still a question to you on the importance of this proposal. As you said, you would like to transform it even more into a Hamiltonian moment, and I personally would completely agree and subscribe to what you just said. But some people, and in particular Mr. Marco Boscolo, a senior manager at Intesa San Paolo, suggest that before your proposal, the recovery plan that the Commission had in mind, or also the Parliament, was in the magnitude of 1 to 1.5 trillion, or even 2 trillion. That was the amount suggested by the European Parliament. So your proposal instead sort of go back, if you want, in terms of size, to 500 billion. How do you see it? Is it that somehow we are limiting the available resources, or how should we think about it?
Well, I think the Europe got somewhat into a bidding process of like who can go higher and who can go higher, and the numbers that were thrown around weren't necessarily connected with economic fundamentals. And what we did with France together to come up with the 500 billion is really do a in-depth analysis of what we think would be the appropriate EU level response in terms of size and scope. And we do have to be careful because we're already seeing in the actual implementing of the recovery fund that it's not trivial for the Commission to scale up its activities to an unlimited amount. And I think what would be the worst outcome is if we had a huge spending program where funds aren't used appropriately or are misallocated, or you have the situation where public funds are just being dispersed for dispersal's sake without a clear concept and economic need behind it. So I think what's important is that in terms of size of the response, in terms of relationship with the EU GDP, especially in combination with all of the measures that have been taken at member state level, we do now have a response of Europe at par with other large regions of the world. And I think what Odile said earlier is extremely important in that context. If you compare it with the response in 08-09, the US got out of the crisis very quickly and forcefully because they engaged in a very substantial fiscal response to the financial crisis. Europe did not at all get its act together, and there was a very divergent response and anything else but uniformity. And then later in the euro crisis, through some measures, we even took contradictory measures, i.e., imposed austerity in a environment where more expansive fiscal policy would have been more sensible. So in that sense, I think that's the past, and I do think the size that we proposed is an appropriate size. So I wouldn't want to engage in, would $1 trillion be better, or 2 trillion, or 3 trillion, and then what's next? I think the key objective is now to show that there is a strong fiscal response, and I think that's also important from a debate around balancing monetary and fiscal policy in Europe, right? I think that's one of the reasons why I think the response in Germany has been quite positive, is I think the vast majority in Germany does understand that you can't go around blaming the ECB for doing too much and at the same time do absolutely nothing on the fiscal side. So I think the vast majority in Germany does understand that what we're doing now on the fiscal side also contributes to taking a burden away from the ECB to always be acting on its own, and to find a better balance between what we're doing in the monetary union and doing complementary acts on the fiscal side as well.
Thank you. Maybe we actually go back to this relation with the ECB later on in the discussion, but this is certainly an important point. So let me go back to Mrs. Renaud-Basso, and let me now move a little bit to the European Commission proposal. So you mentioned it before, but the question more particularly would be, how do you consider this proposal? Is this very faithful somehow to the French-German proposal, or do you see it diverging, and if so, in which aspect?
No, I think the Commission proposal is very faithful to the Franco-German proposal. Basically, the Commission proposal takes up this idea of a fund to finance a budgetary expenditure of 500 billion euros. They add up on that loan facility to provide some loans for countries that would request it on top of that. And I think the logic and the overall framework is very consistent with what we proposed. Of course, you will always, and there are other components with some capacity of intervention in equity. So there are a number of different instruments which are proposed. We will have to discuss that in detail. But I think the key, the bulk of the proposal will rely on plans that will, the recovery plans that member states will have to present to the Commission, and which will receive some support. Countries will have to present both investment, expenditure, what the money will be used for, and what kind of reform will accompany this strategy. And the Commission will make a judgment on all of this, and will provide some support to the countries. There will be some discussion. Some countries have opened up the discussion on the allocation key, what should be the parameters in the amount allocated for different countries. For us, I think the key element is that the allocation key reflects the impact of the crisis and addresses really the economic fallout of the crisis. But basically, I think that the key features of the European proposal are very consistent with what we proposed, and have a very good basis for an agreement.
Thank you very much. Back to Mr. Kukies, something that you mentioned before. So you said before that, of course, the first measures that were introduced were those at the national level by the single member states. And as both of you actually said, that somehow there have been some divergences. Now, you claimed before that the German plan is not so much bigger than maybe the national plans of the other countries, but of course many people feel differently, and they feel that the relaxation of the European state aid rules may have contributed to it. I understand that you say at the end of the day, if we look at the KfW program, only the amounts that have been used so far are comparable to France, but nevertheless, the amounts available, at least those that can be used, is somehow much bigger than in many other countries. So many people see this EU recovery fund, or this EU proposal and your French and German proposal, as a way to overcome these asymmetries. Now, as Mrs. Renaud-Basso has just said, this of course will depend on how the funds will be used for the different countries, and the details still have to be spelled out. But in general, would you think at this more general level that this proposal and the Commission proposal is enough to somehow really avoid the divergences, even in the medium to long term across countries?
Yeah, so I think the difference comes from the fact that the capacity that we gave to our economy in loan guarantees is essentially unlimited, and we took lessons from a very famous central banker from Italy, who gave us sort of the prototypical example that in order to calm markets, providing unlimited amounts of accessible volume can be an extremely powerful instrument. And in terms of liquidity provision to the real economy, there is one fear that we had is if we came out with a limited program and a small program, we could get a difficulty of corporates basically loading up on liquidity who don't really need the liquidity, simply out of fear that the funds are limited and would run out at some point. And that's the simple reason why we went so massively large. First of all, with a commitment to go to whatever volume is requested, and then by expanding our guarantee framework up to 860 billion euros, with the ability to increase it by simple administrative act by another 20%. But as I said, the stats I just received, the numbers from today, were at 46 billion. Odile in France is at 100 billion, right? So that's the reality. So in that sense, I think it's very difficult to argue that Germany is doing much bigger programs than anyone else in Europe and providing unlimited amounts of financing, because the terms and conditions that we asked our corporates for are completely in line and in many cases far above what the EU temporary framework has as minimum interest rates and yields, etc. So in that sense, we're as onerous as others and completely in line with the terms and conditions. So a French company can get state guaranteed loans at exactly the same terms and conditions as a German company. So there is not any kind of unlevel playing field there. And the fact that French companies use the system twice as much as Germans also tells you something, right? So in that sense, I think we're in line, and the Italian program is very large, the Spanish program is very large in terms of provision of guarantees. So this is not only a Franco-German idea, but it's an idea that's prevalent across Europe. What we also did, I think, and that I think is the important leveling of the playing field. We gave the EIB a 200 billion euro facility to expand provision of guaranteed credit to SMEs and other corporates as well, right? So that was to me the biggest unlevel playing field, that some member states in the European Union simply don't have access to BPI or KfW or ICO or the various promotional banks to the extent that the large member states have. So I think the fact that we are using EIB to provide the same type of state guarantees for lending, I think is extremely important. And the funding conditions, given that EIB is AAA and has very cheap access to funding, also shows that we can achieve a level playing field in this area, even in those member states that don't have promotional banks. And I think that's extremely important for the functioning of the internal market.
Thank you. Before we move to more the details, also in terms of the implementation and what will be required to get approval somehow, and what would be the timing that you envision, although you have already mentioned something about it. Let me go back to Mr. Renaud-Basso on one final question on more general level, which is the role of Europe versus the rest of the world. So, as you have said in the past, in particular after the global financial crisis, Europe probably has reacted too slowly and not in a way coordinated enough, in a coordinated manner. So this again can be a game changer. So how do you see the role of Europe going forward? Now China is a bit weakened because of the pandemic occurrence and all maybe the rumors about their contribution to that. The US is also in a weaker position. So how do you see Europe? Can this be a moment in which Europe somehow takes the lead again going forward?
Yes, indeed, it's very important, I think, to acknowledge the fact that Europe has reacted very, as I was saying, very quickly, very forcefully, and combining national action and European action in a way which has been very consistent, I think, even if, at national level, each country was looking for very quick action, but at the end, it come very consistently, I think. And one very important part of the Franco-German proposal that we have not mentioned yet, but I think is also makes a lot of sense in relation to your question, is the objective of enhancing European sovereignty, having a European with the capacity to defend its interests compared with if you have countries or counterparts not abiding by the rules in terms of subsidies, in terms of openness of markets, and so to equip Europe with means to address this kind of challenges. I think we have been living in Europe with what has been called yesterday by some commissioners as a naive approach, sometimes being too open, very based on principle for openness, not looking at reciprocity and so forth. We need to be careful not to move on the completely other direction on the protectionism, which is a trend which you can see quite developed in some countries currently. But I think that Europe needs to be assertive and to have the tool to defend its interest when you have an unlevel playing field at the international level. And what we are doing with this is part of the strategy underpinning the recovery plan. And I think it's part of one of the key objective of the Commission in responsibility, and I think we start to see what kind of policies on trade, on investment strategy, how to be sure, because the crisis creates some risk in that respect. For example, with the valuation of companies that could trigger some appetite for third countries investing at low cost in very strategic European companies. And I think what is being done, the reflections ongoing on how to implement some framework to ensure that the investment, foreign investments are we are not, we have the means to protect some key technologies for our future and so forth. This is a very important objective that is now much more widely shared at the European level, and that should help Europe to be much stronger at the international level. Accordingly, the focus put on digital and energy transition are very important for Europe at the global level, so as to first of all, catch up on what I see as really a sort of lagging behind position on technologies related to digitalization and so forth. I think Europe has really to catch up and to develop its own tool on the cloud, for example, or on the new technologies in this area, and with the focus we have on the climate change and the money we put on this priority, I think that will give us sort of natural lead globally on new clean technologies in all the areas of transportation, industry, and so forth. So I think that both the strategy and the additional means that we are putting in place will help Europe to be stronger globally, and I think it's very much needed when you see the challenges and the uncertainties and the tensions at the international level.
Absolutely. So let me ask one question to Mr. Kukies that has been posed by Professor Mario Monti, that you probably know very well. He's the president of Bocconi University, a former prime minister, and also the chair of the European Group on Resources. So he poses a very articulated question. Let me summarize. He welcomes very much the French and German proposal. He sees it as somehow having the ingredients for a federal budget, and at the European level, not just the euro area, because sometimes we also always have this dichotomy between Europe versus euro area. But he also underlines that the approval of the proposal somehow requires the unanimity in the Council and the ratification by all the member states, which of course raises the bar for the approval and the move forward and the real implementation of the proposal. So the question is, what strategy will Germany and France deploy to achieve this very ambitious political objective and quickly enough? Please.
Yeah, I mean, I really think the sort of positive second round effects of having the recovery fund could be huge. For example, this need to have unanimity and and get an approvals process and ratification for raising the own fund ceiling and declaring debt issuance as an own resource as per Article 311. Of course, it's difficult because the requirement of unanimity, but I think that's a difficulty that we would have had anyways, because, you know, for the MFF, we also need unanimity, and pretty much every member state then needs to ratify the agreement on the MFF in their respective parliaments, simply because it's such a large budget item. So I think, you know, the need to strike an agreement with unanimity and get all of the national parliaments on board is something that we would have had to do in the course of the 21-27 MFF anyway. So I don't think that's a huge incremental barrier to an agreement, because all of these things at the end of the day need unanimity anyways. But at the same time, you know, the huge benefit if we achieve this goal is, for example, the whole quite toxic debate about the European safe asset all of a sudden becomes a much more realistic and pragmatic one, because if the European Union issues 500 billion, 700 billion of EU debt, all of a sudden you do have the euro-denominated safe asset, which is coherent and cohesive and uniform across the European Union, denominated in euros. So I think that's also a huge potential unifier. And a very positive read across in the whole debate around the banking union, the capital markets union, again, the sovereignty and strength of the euro, which, if it's held abstractly, doesn't have a huge amount of consequence, but if it's concrete in form of completing the banking union and the capital markets union, and making steps towards the fiscal union, could be a real game changer in terms of getting more momentum on all of these quite difficult issues. So I think that could also lead to this new momentum. And the question of Professor Monti and the unanimity requirement, I think, in a way can also be seen sort of glass half full, because once we have unanimity on these issues, it could also be a catalyst for agreement on a lot of other very fundamental and difficult questions in the EU that are also hindering this agreement towards stronger sovereignty of the EU.
Mrs. Renaud-Basso, still on this issue. So this requires unanimity. But if we cannot reach a unanimity, do you see other avenues to progress? And also related to that, the biggest resistance that we read also today or yesterday in the Financial Times has been advanced by the Frugal Four, the four countries. What do you think are the main obstacles for them to accept the proposal? So my understanding is, for example, that whereas they agree on the need of a recovery fund and the way this recovery fund will be used, so the digitalization, the green policy, the various priorities, they very much oppose the idea of grants, and they rather prefer loans. Do you think this is an obstacle that would be very relevant, or do you think this can be overcome in some way?
I mean, on the first part of the question, which is there a way to circumvent the unanimity principle? I mean, I don't think so. I think that if we want to move forward, we need to have to reach a consensus and to have an agreement reached by all countries. I think that, I mean, in principle, you can think about solution where you have all countries but a few number, but I think politically it will not work. I think that would be a major failure. It will not be the EU and all other options at some point before this proposal. We managed to reach an agreement on this proposal. We had thought about different schemes where you had a sort of more intergovernmental with SPVs, with a guarantee by member states outside of the EU framework, a little bit like the EFSF or the ESM. But even for this to work, I think you need to have all concerned countries participating. Otherwise, you really, I mean, that would undermine, I think, the EU, and I'm not sure politically it would be feasible. Then on what needs, I mean, what is on the table to manage, I mean, what kind of margin do we have to reach an agreement? First of all, I think that, I mean, now there is a shared, and we will see what is the outcome of the European Council tomorrow, but I think there is a shared understanding and a commitment to do something like a recovery fund, to work on this, and an understanding of the need and the fact that this is very, very crucial for Europe. Then I think that, as I was saying, to be very clear that what we are discussing now, and we may have further discussion later on, as Jörg was saying, and we would really fully support that, but what is on the table now is something temporary, targeted, and it's not the beginning of something else. It's very well framed and defined. Then on the issue of grants versus loans, for us, this is a very fundamental issue because we believe that loans would have a very different impact. If you provide a loan to a country, this is in its debt level, so this increased its debt, even if it's very long term. Loans can imply transfer if it's very long with very low interest rates, so it's a way to provide some support, and it may be relevant, but we strongly believe that we need to have a large share of expenditure. And I think one very strong argument for that is that it's in the interest of all European countries to avoid the collapse of one country or the other, and to ensure that all countries are getting out of the crisis with strong growth, investment capacities, and so forth. It's a sort of investment EU, and all EU countries are doing for the sake of the common good. So I think this is strongly pleadable, and then you will have a discussion on at what conditions, the allocation, as I was saying, and then at what conditions, what kind of reforms, what kind of scrutiny we will have to ensure that the expenditure are efficient and provide really providing support for growth. And this is fully legitimate. So I think that I'm quite optimistic that at the end we will manage to have an agreement.
I applaud your optimism, and I very much hope that this will be realized in a way. Let me go back to Mr. Kukies. I see that we have just a few more minutes, and then I certainly don't want to go over time because I know you have other commitments. So some people are asking whether you can elaborate a little bit more on what you said before concerning the ECB. You said that somehow this proposal also originates, or at least is related to the need of not letting the ECB always being somehow the player in town, the one that always has to step in because we don't have any other strong European measures. Is that true? And how much can this be related to the German Constitutional Court?
Yeah, I mean, I think the discussion that we're having now is not an outcome or a result of the decision by the German Constitutional Court. I would say more that it is an indirect answer, but it's something that this asymmetry between monetary and fiscal policy, which in a way is sort of a construction problem of the European Union, is a tension that's just been building basically since the existence of the European Union and the monetary union, because of course the agreement to integrate completely monetary but leave fiscal at national level, that almost automatically leads to conflicts and tensions and incentive problems. And I think what we've been going through on Stability and Growth Pact and all the debates around that are sort of an outcome of this asynchronicity that we have of constructing an internal market where you have this divergence between monetary policy at the union level and the fiscal policy is still pretty much widely being decided autonomously, of course being better and better coordinated, but at the end of the day the liability is still being on the hook for at the national level. And of course, if we want to move towards deeper integration, that's exactly the area where we need to where we need to address, and that goes back again to the question of what kind of a fiscal union do we want to have, and of course it's a highly political question because every member state will have to answer the question of are we willing to not only talk about European sovereignty, but are we also willing to give up some of our tax sovereignty and move it to the European level? Because at the end of the day, markets will only give credibility to this concept of fiscal union if there is a tax capacity at the union level. The U.S. Treasury doesn't go to California, Nevada, and Arizona and ask for a state guarantee if it wants to issue USTs, right? Because the market knows the tax authority and the tax capacity of the Treasury is so strong to repay debt that it does so autonomously. And if we want to move ahead with the union, we'll have to solve all of these issues. And I think that is the difficult question that we all have to answer. Is it's very easy to call for maximum flexibility on the Stability and Growth Pact, but if we want true fiscal union, we simply can't each have our own fiscal spending and revenue policy at the national level, right? We have to concede that kind of sovereignty gradually. I mean, if you read the history of the fiscal union of the United States from Hamilton to true completion of the fiscal union took a few decades, right? So I guess it would be unrealistic to expect this to happen quickly. But those are the very deep and fundamental questions that we have to ask, and only then I think will this asymmetry between monetary policy and fiscal policy, which is leading to a lot of the tensions that we're experiencing at the moment, be resolved. And that also includes quite a lot of the things that Odile has mentioned in terms of using the recovery instrument to get the European Union to a higher growth path. So I think that's really the key, and that's also some of the questions that I'm reading on the chat relate to the Frugal Four. I think that's the key element to get the Frugal Four, as they're called, on board, is to convince them that what we're doing with the budget is not simply fiscal transfers to member states, but is truly growth enhancing fiscal policy that will lead the EU to a higher growth potential path.
Many thanks. If I can steal a minute from your time, just a very quick question to Mrs. Renaud-Basso. We haven't talked about banks so far. So the Commission proposal, the French and German proposal, is related most of all to the real economy, as it should be, given that this is the part of the economy that has been hit first. But of course, given the GDP reduction that we are expecting in all the European area, we should expect also that at some point we will have problems more for banks as well. So how do you see it? Do you see the need of appropriate measure for banks going forward, or do we rather need to strengthen the solvency of the firms? Because indirectly, this also will help the financial stability.
I think it's very early to say now what will be, and to have an in-depth assessment of what will be the impact of the bank, because it very much depends on the structure of the recovery and the path of the recovery. Depending if you have a V recovery or longer term recovery, the impact on NPL and so forth would be very different. What is very striking is that all the measures taken by government now have a sort of effect that suspend all the impact on the real economy, the impact on the companies and so forth. So what we see in France is absolutely, no increase in bankruptcies and so forth, but that may come, and we expect that some things will come later on in the autumn, probably. So I think that there will be an impact on NPL, and we can expect that. I think the situation is much sounder than what it was overall, is much sounder, much better than what it was at the beginning of the global financial crisis, that there is, and there also the reaction of supervisors and so forth to give some flexibility has been extremely rapid and extremely helpful, I think. So we will have to monitor that very closely. The SSM is doing its work, and I think we see the benefit of having the SSM and these elements of the banking union to have an overview very consistent with the same methodology and so forth, and that will give us a better assessment of where things can go and different possible scenarios. And I think that we have all the framework with all the work done on the banking union, which is not finished, but which has made good progress. We have all the tools to be in a position to address the situation. I think one missing point, which is on which we need to further work, is to get the backstop ready. This is related with the ESM treaty reform, and I hope that we can make this move ahead again. But this is a complex discussion in some countries at the political level. Thank you. I really have to go out to stop.
Yeah, no, I actually know it, so I want to close the webinar now. Thank you very much again for having been with us, and really thank you for this very interesting discussion. Thank you very much, and bye-bye.